Good morning, everybody. It's Thursday, December 21st, and this is the AgYield War Room. I'm Dan Dempsey, and I'll be moderating today's session. As always, if you've got any questions or comments, please feel free to drop those in the chat area, and we'll get to those during the show. You can always reach out to us also at info@agyield.com with any thoughts or comments that you'd like us to address. Real quickly here, overnight markets had March corn up 3/4 at 470.5. January soybeans were down 3 at 1305.25, and March Chicago wheat was up 4.5 at 614.5. We had export sales out this morning. Corn was just a little over 1 million, which was in line with expectations. Soybeans were solid, 1.989 million for the week. That was the upper end of the estimates, and we also had 144,000 that were in the sales for 24. Wheat, lower end of the estimates, 322,000 for the week. It has been some time since we've seen an announcement there on the wheat side. Going forward here this morning, we were talking just a lot more noise about 24 marketing, whether it's using, accumulator type contracts and low vol environment. We just wanted to talk about some thoughts that maybe we have on looking out forward with corn still above $5 out to December 24, with a lot of unknowns here at play. Just wanted to see what that really means. So I'll throw it over to Dustin here to start us off this morning. And thanks again for tuning in.
Yeah, thanks, Dan. So we, this time of year, a lot of people are kind of, obviously there's a lot of bushels that still want to be marketed for 23 crop. But looking at the March contract hitting new contract lows yesterday below 471, and thinking about that contract low in the Dees contract at 447, a lot of people are looking at that, $5 number in Dees 24 corn, 502 right now, and saying that, hey, maybe that's not a bad sale. I don't want to get stuck selling something in the fours again in harvest. So we get a lot of comments like that around, moves like this where we're making new contract lows. And one of the things that we see a lot of, and this is being pushed, I think, from a lot of delivery points as well, is, hey, if you missed it, you can still go get a 540 price by doing some sort of accumulator, right? And an accumulator, for those that don't know, it's where you're dedicating basically risk to try to get a premium to the market, and that risk is in the form of extra bushels that would need to be sold if the market goes higher. So, for example, if you do a 540 accumulator, if you happen to be above 540 at the time that it expires, you got to put in a second bushel at that price. So, of course, if the market does something where it runs higher in the spring, that's a risk that we have to hang out there, but it's not actually an asset for a lot of these accumulators, right? The problem with the accumulators that we see right now, when we're hitting new contract lows and volatility still in the lower 20 percentile ranges for Dees 24 corn, is that it's kind of a counter seasonal sell-off right now for a lot of growers. Break even is in the lower fives, 520 to 540. And we need to really sharpen our pencils about getting some actual assets of sales if we are running into a 520 to 540 range, rather than being stuck handcuffed by an accumulator. Now, I'm not saying accumulator is bad or not going to work. I'm not saying that at all. I'm just saying consider the costs of doing them, because accumulators really aren't about creating certainty. They're about trying to get a premium by taking on the uncertainty of the outcome. And there's a time and a place for those. We have a lot of times that we might have recommended those over the years. Usually that's going to be like, higher volatility environments, when there's a lot of time on them, especially if there's something that's 2 years out, we're much more prone to say, hey, that's a good idea. Try to get a premium in association for something we know we're going to have to sell down the road. So.
And that's really good. Ben, anything to add on your side? I know you work real closely with a lot of our commercial relationships, and I figured maybe you had a little something to add on that front as well. You're muted there, Ben.
Kind of echoing what Dustin said, there's a time and place for them. I also think that there's something that you have to take in small bites. Sometimes in the worst part of price move, they start to feel better as people do something as opposed to doing nothing. Understanding the risks involved are very important, and the type that you're going to get involved with. But it's still a strategy that you have to be really small bites on, regardless of the values, because the last thing you want to do is have yourself tied up on a fairly large percentage of your production should we get some sort of rally, whether it be stoked by good business, good export business, weather, any of the things that we've seen in the past. So, it's a small bite trade, and certainly you want to talk to your advisor what other alternatives are at this point. So,
that's said really, really well, Ben, because what are the alternatives to the accumulator? Obviously, there's doing nothing. There's making a cash sale. There's buying a put option. There's a lot of different ways that you would hedge grain. And so if your concern is that corn prices could continue to slip away, I'll give an example, like a year such as 2020, for example. We had an early season sell-off that year, obviously for COVID reasons. And so anyone that was trying to get certainty out of the year, if they had signed up for accumulators, they might have been knocked out with less than 20% priced. So in your best case scenario, an accumulator that's got a double up, the most that you're going to see people do it would be something that commits them to less than their guarantee. So if they have an 80% guarantee, the most they could sell is 40% on an accumulator, because that could push them 80% sold. That's still more than most people would do. Let's say you have a 40% accumulator, which would be very aggressive, and you only get 20% sold. Now all of a sudden we're talking 8% sold, right? It doesn't really provide much certainty for, even though the premiums might look really, really attractive and be above break even, opportunity costs a lot of times can be very high on those. And you just got to weigh those against other options. And that's what we're trying, a lot of what we try to do, with the calculator.
Well, and I think a pertinent part of that also is kind of an individual's preference on how they market. If you're a person who your annual plan is you only want to be 50% harvested or 50% sold going into harvest, and you're willing to store a lot of bushels on price, and that's kind of your MO, they make a little bit more sense versus someone who really wants to be heavily marketed at some point, because you're gonna, in theory, you should have additional bushels to account for the accumulator. And I think where people get themselves in trouble is they put it on and they forget that they have a tail of it should we rally higher, and all of a sudden there's kind of Monday morning quarterbacking of why you did this, and it's 60 cents below the market. And I'm not saying that we're going to go to 60 cents above whatever those accumulator values are today, but we have seen it happen in 2021, in 22. So you have to be really careful. And I think choosing the type that you're getting in, it's really important to understand it, that it's an apples to apples type of transaction, especially if you're looking at it from different providers, and understanding what you feel like the actual risk is in that program, because you can do ones with floors. You've got to be really okay with the potential of a double up, and you've got to be okay with the risk proposition of, hey, if we break, like Dustin said, yeah, I did 20% at a great price, but the other 80% now is 40 cents or 50 cents below the market. So it's a small bite transaction for anyone. And I would just caution anyone to talk with your advisor on that risk prop to go through what is the best fit for you.
That's good stuff, guys. I'm sure that as we go forward here, we're going to continue to talk about these tools and what market environments are bringing this to the forefront. So no, it's good stuff. I wanted to touch on that this morning. Let's pivot a little bit here. Let's talk markets. Brian, looks like this morning we're raining again in Brazil. So what do you got for me on the weather front?
Yeah, Dan, appreciate it. Argentina to start off with continue to get beneficial rains. They've been the garden spot for sure. Brazil, the big boy, though, they've been hit or miss, but it looks like this forecast that's coming through for the next 5 days should be really beneficial starting through the north and moving central south. So looking really good there. I think the soybean market's kind of caught in between, these beneficial rains coming in the next 5 days and the production cuts. Private analysts are cutting, their Brazilian soybean production just based on this early dryness in November and December. But, we saw what happens on our front with a dry June. I think it's still too early to put all your eggs in one basket. So we'll continue to monitor South America and their weather, but it looks like they should be getting some really beneficial rains here in the next 5 days. Coming to our front on our home ground here, the drought monitor just came out. The Midwest is extremely dry, especially Iowa. So we really need to start monitoring our own front here. Looks like storms should be firing up in the south here, moving through the plains and Midwest. So we'll just have to see how this thing kind of plays out and see what the totals bring us.
That's good. And it's early, so just full disclosure, we're not panicking about Iowa right now, but you got to be cognizant, right, Dustin?
Yeah, absolutely. That is something that we are getting a lot of questions on, though, because I think growers in that area are obviously they're super aware of how dry it is. And, they are still a big portion of the market, like market participants. So how does that sway how they will feel about selling corn, and selling out forward? That would definitely sway their decision. They are very much part of that market participant. So the longer we go without a solution to that dryness, we're not getting the rains, in the spring, or we didn't get, a great relief from moisture as we get, into that March timeframe. It could get kind of interesting because if you look at that drought monitor, it is historically dry right now. I mean, there's a very, very big portion of the Midwest that is under extreme drought.
Well, it's unbelievable. It's hard to believe it's going to be, sprinkling and 50 degrees on Christmas this year. It's like,
yeah, right.
It's unbelievable.
Yeah.
Well,
I
kind of think that, Brian really put it well, that we're kind of caught between some inputs here of good rain, good weather now. We're doing good business domestically in soybeans. We do have option expiration, and there's almost 10,000 open in the $13 line. We've seen that Jan-March spread come in really quite a bit here. We tend to have some moves after option expiration, and like I said, there's almost 10,000 open in the $13 line. So I'll be really interested to see how beans react following option expiration. I think that the general idea is that the options market is 3x, 4x of what the actual futures market is. So not everyone can always get paid in our markets, and I'll be really interested to see what soybeans do coming out of a long weekend and getting OPEX behind it.
Yeah, and thin holidays too.
Right.
We can't discount that piece too. I mean, like we've been talking about, it just it might make sense for you to look at things and get some, what may appear to be crazy orders in if you're trying to catch up on something in the next 10, 12 days, because you wake up and for whatever reason, you might get some kind of a weird spike just because of thin volume. So, probably something to look at.
Right. We've seen an uptick in basis in some parts of the river here for beans. And, of course, for January timeframe, we're going to be the main player here. Export sales today, if you look at, who those were going to, is about 1.5 million was going to split between China and unknown, right? We had a pretty good export sales report again, and then an uptick in basis, and you're seeing what's happening in the Jan-March spread. So there's still kind of a question for that, what's if the Jan-March spread's already rallied 15 cents in the last 10 days, what's it going to go do into first notice? Right? There is a cue that the market's giving us right now. So it could get interesting here. Like Ben said, maybe it's after option expiration, but maybe it's even before, just because you start moving that dramatically on the spread this early. It's just something to watch.
Yeah. On the point to basis, we did see river beans in Ohio spike to 15 over, which I say spike, that's well off harvest lows. 15 over for Jan delivery yesterday. And to me, that is comforting. We've talked before about the possibility of greater cancellations. Were we getting purchases to protect against uncertainty in South America. But that's a little bit encouraging that we are going to chip a fair amount of those beans, or at least we're headed in that direction, unless it's a one-off. So that certainly is encouraging. When you look at a lot of beans moved in the fall, and people tended to store corn because of the price difference. Now you're going to start seeing, after that 2 months, processors are going to start needing more beans. And then if we can get a river market, it's definitely something to keep an eye on here as we move forward. I think the market will tell us what they think of South American supplies, maybe a better picture here in the next few weeks.
Sure. We're going to be coming to the open. Rylan, you got a cattle open for me?
Yeah, we're a little mixed this morning. Good close yesterday, but the live side still struggling with the 25-day moving average, just cannot punch through. And we've got cash and futures pretty well converged just so far, with the light trade that we've seen about 170 in Kansas yesterday, and then we saw a little bit 270 dressed in the north. So that's definitely better than what we've been seeing. The tone has been much more positive. So it looks like just this kind of feeder-led rally that we're seeing right now. And feeders are carrying over the 25 days. So it does look like seasonally, it looks like the funds are probably starting to bail out of their short feeders. Producers starting to pick up some feeders at cheaper prices, and there's just a little bit more optimism. The cattle on feed estimates, I think, gave people a lot of confidence that we weren't going to see that 6, 7, 8% higher placement number just to kind of shock everybody. So moving in the right direction. It is kind of, I think we're limited, at least at this point, how much higher we're going to get just in the front end of the market, just because of cash. And we're kind of running into that kind of end of the year kind of trade where it just feels like right after we kind of hit, after the beginning of next week, we just kind of fade. So would expect a little bit more kind of strength going into the report tomorrow.
Very good. Yeah, and we'll have the reactions to that report in your commentaries there tomorrow afternoon.
Right.
So here's grain open here this morning. Corn pretty much unchanged here in the March, 469.5. Jam beans down 7, 1301.25, just off the low. And March Chicago wheat's up 4.25 at 614.25. Ladies and gentlemen, every day streaming live on X, Facebook Live, and YouTube, 8:15 Central Time. We appreciate everybody's comments and thoughts here this morning, and we look forward to wrapping up the week tomorrow. Hope everybody has a great day. We'll talk to you soon.
Thanks,
Dan.
Thanks, Dan.